Hey, very good morning to you traders. A lot of new guys into spread betting ask this question. They say, what actually moves the market? What am I betting on? What is a spread bet? How does the market actually move? And how is price determined? It is such a good question because, when you're starting out, you kind of look at the market and you go, well, I don't really know why the price is that. Who decides the price? Why does the price go up? Why does the price go down? So short video now, I'm going to run through a little bit of the basics about what moves a market and how price is determined. Okay, so very quickly, markets move, they're based on supply and demand. And we'll get to this point in a little bit more detail in a second. But fundamentally, it's an auction process. So it's basically where a buyer and a seller have agreed a price. If you had a buyer who was looking to purchase an apple and you've got sellers who are selling apples, the buyer's going to go to one of the sellers and say, hey, I'll buy one of those apples off you for 50p. That is now the price of that particular type of apple, whether Granny Smith, whatever it may be. Okay, now another buyer comes along and he's looking to buy another apple this time. A lot of apples have sold out and there's only a couple of sellers left. He might agree a price that is £1 for an apple because the supply demand, a lot more demand coming in, the supply is diminishing, or the supply is diminishing in that moment in time, so the price is going to go up. But anyway, generally, markets are traded on a centralised exchange. London Stock Exchange, New York Stock Exchange, NYMEX, etc. Numerous exchanges out there. Now, Forex is a little bit different because it's basically priced from a group of banks trading with each other on the interbank market, and the aggregate of those prices is generally what the spread betting companies use. That's why you get slightly different variations in price between spread betting companies, but not a lot, but just very slightly from time to time. But ultimately speaking, they're just using the bank's feed and then getting an aggregate. And what happens is the big banks are always updating their prices for buy and sell, making a market depending on what the book they've got, what orders they've got coming in, and also just their market making stuff with the interbank rates for retail and institution. So that's how our Forex is priced. Players and participants, we've got three levels that I look at, generally speaking. Institutions, which are banks, hedge funds, pensions, mutual funds. Retail, which are small trading firms, small prop firms, independent traders like you and I, and then investors. And then we've got HFT, which are high frequency traders, which are algos, and they're used to purely scalp small price movements. These aren't the algos that big institutions use to split up orders. That's a different thing. These are algos which are using just to scalp small price movements. Okay, so these are the players that are involved in the actual futures market, or in the actual exchange market, in the stock exchange, in the actual centralized area and venue. So bearing that in mind as we move on and look at what moves the market. So let's just first think about why a person is going to buy. Now, a person, I'm just generalizing here, it could be an institution with a 1 million share order, a 1 million contract order. It could be a person with a 1 share, 1 contract order. He buys because he thinks the market is going to go up. Okay, simple as that. Now, either he's covering a short or he's buying to investment, whatever. That's the reason that someone is buying fundamentally. So why is he buying that? Because he thinks that somebody, after he's bought, is going to buy again, causing the price to rise. Now, there is a bit of a fallacy in trading, and you hear this sometimes in the mainstream media, and they say, well, there's more buyers than sellers. That is not true. For every buyer, there has to be a seller. There has to be that, because a transaction does not take place. You can have as many buyers in the world, but if there's no one to sell to, a transaction is not going to take place and a new price is not going to be printed. So for the market to go up, buyers have to become more aggressive than sellers. In other words, there are the same number of buyers and sellers, but the buyers are prepared to pay a higher and higher and higher price, causing the market to go up. It's supply-demand seesaw, the way I look at it. You've got demand pushing down and you've got supply pushing the other way, and then when they're in equilibrium, the price is the same. When you've got a massive amount of demand coming in, so huge amount of demand, the price is going to go up, and little supply. It's the same theory with anything in life, ultimately. Cars, houses, that kind of thing. It's just a free market environment, but it's far more focused and far more free moving and active in the actual exchanges. And one thing to note here is that for a spread betting perspective, spread betting companies just track the actual exchange prices. So they'll add a bit of a spread on, and I'll go to this in maybe a detail in another video. They will create an artificial cash price based on the futures price, like for the FTSE, the DAX, the Dow. However, they are just tracking fundamentally the futures prices and then creating their own price from that. So they aren't actually moving the price, they are just tracking it and adjusting the spread. Sometimes they adjust it in high volatility environments, sometimes they contract it, but ultimately, they're not big enough to move a market. They are just tracking the bigger market and providing us a venue to make that trade in a betting environment. Right, so let's move on and just look at this example quickly. A market moves go hand in hand with volume. This is something that is very important as well. And as spread bettors, sometimes we forget this because we don't get volume from spread betting because it's an artificial synthetic representation of the real market. But if 100 shares traded at, say, 201p or 5 million shares traded at 201p, it doesn't matter. The price is still 201p or whatever market we're looking at, $50 a barrel, whatever. It does not matter. Volume is irrelevant in terms of determining price. If the supply equals demand, regardless of the volume, the market is not going to move. And if I use an example here, and I kind of like you to seesaw example, you can have supply here of one contract. Okay, one contract and demand of one contract, you're going to get a price forming here. That supply then could go up to 1 million contracts and demand can be 1 million contracts, you're still going to get. But what happens is when supply and demand are out of balance, that presents the opportunity for traders. If we have supply coming in at 1 million contracts, put a comma in there so we can see what's going on, 1 million contracts and demand is only one contract, that price is going to be whatever the print is there. But if these guys still want to get filled, they're going to have to lower their price expectations until they meet demand. That's why it's an auction process. And if we move on to this example here now, which is my kind of crude analysis or crude representation of the depth of market, which is generally how the exchanges are traded. You've got on one side, you've got all the people willing to buy. So this is the bid side or the buy side. And on this side, the formatting is a bit out of skew, but you get the idea. These are all the people looking to sell. This is the ask or the offer. In the UK, we tend to call it the offer. In the US, tend to call it the ask. So you've got basically people queuing up saying, I'm willing to sell 20 units. It could be futures, it could be futures contracts, it could be lots, it could be shares, whatever. It doesn't really matter. It's all obviously going to be in a specific format depending on the exchange it's on. So I've got to sell 20 units here at 104. This guy wants to sell 25 at 103. This guy wants to sell 21 at 101. And here are all the buyers queued up. So 100, this guy's willing to buy 20, or it could be a mixture of 20 guys willing to buy one. It could be split up into many different things like that. 99, 98. So at the moment, we've got no transaction take place. When a transaction takes place, someone is going to come along and say, okay, I want to buy, so I'm going to pay 101. I'm going to buy one off this guy. This will then go down to 20, and you've got one of these units, whatever it may be. So the price then becomes 101. Or you say, you know what, I don't want to pay 101. I'm not going to pay more than 100. You stick yourself on 100 in the order book if you're trading direct in the exchange. That would then go up to 21 because there's 21 total volume there and you're bidding 100. Okay, so what happens now is that this is where you've got this is your demand, this is your supply. If all of a sudden someone comes down and sells, I'm not sure how number that is, but if he sells all the way down to 95, let's say he sells 100 contracts, I guess there's about 100 there, then what he's going to do is he's going to end up taking 100, 99, 98, 97, 96 because he's more aggressive than the buyers. He's been matched with this guy, this guy, this guy, this guy, this guy, and he's now left here with 5 contracts on the offer, and the new price is now 96. So you can see that it's the supply demand that moves the market. It's whoever's the more aggressive that moves the market. If I'm an aggressive buyer and I want to buy 50 contracts, I'm going to end up taking all of those at 20, all of those at 30, and there's going to be one left there. The new price is going to move up 2 ticks. Someone else who's aggressive as well may come up and buy. Someone else may come up and buy. Someone else may come up and buy. That may be enough to bring in sellers who then say, you know what, that's a good price for this at the moment. I'm going to sell some, and it steps down again, steps down again. And that's why markets move up and down, up and down. And when you get the real supply-demand imbalances, you get the rockets to the upside. That's just massive, massive demand coming in. Often you get the little pause there as it backs off and waits. No supply coming coming in and then you get another leg. That's where you get the chart patterns. That's when you can really capitalize on that imbalance, and that's where we make money as traders. So anyway, hope that kind of explains it a little bit. Not spent too long on it, but just want to emphasize the supply and demand imbalance, looking at it like a seesaw, and actually ultimately understanding that volume is related to how price moves. But ultimately, if there's an equal number of volume on the buy as the sell and transaction takes place, then it's irrelevant. It's all about how aggressive the buyer is and how aggressive the seller is.